What if I told you the biggest financial disaster of the 21st century didn't begin with greed, but with trust? Yes, trust. Trust in banks, trust in numbers, trust in a system everyone believed could never fail. So how did a world built on confidence collapse into panic almost overnight? Today, we break down the 2008 financial crisis in the simplest way possible by following one question. What really broke the economy, or the illusion that it was safe? Before 2008, the global financial system looked unstoppable. Banks were growing. Housing prices kept rising. Wall Street was inventing new financial products faster than regulators could understand them. Key players, from mortgage lenders to big investment banks, all believed they had cracked the code of risk-free profit. But beneath the shiny surface, cracks were forming. Cracks nobody wanted to see, because those cracks were tiny at first, hidden inside millions of home loans. It begins in the early 2000s. Interest rates were low, money was cheap. Banks realized they could lend to almost anyone, even people who could not afford a home. These were called subprime mortgages. But here's the twist. Banks didn't want to keep these risky loans. Instead, they bundled them into giant financial packages called mortgage-backed securities. Ratings agencies stamped them safe. Investors bought them like crazy. Everyone made money as long as home prices kept rising. Spoiler, they didn't. By 2005, 2006, the housing market was booming. People bought homes with no income proof. Banks offered loans with tiny early payments that would later explode. The more loans they sold, the more securities they created. It was a perfect machine powered by two dangerous assumptions. Housing prices always go up. Risky loan becomes safe when you mix it with other risky loans. Both assumptions were dead wrong, but nobody cared. Yet then, the unexplained happened. Home prices stopped rising. Suddenly, millions of borrowers could not afford their payments. Defaults exploded. Mortgage-backed securities began losing value. Banks panicked because they didn't know how much toxic debt they were holding. And then came the moment that shocked the world. Lehman Brothers collapsed, one of the biggest investment banks, destroyed by its own mortgage bets. This wasn't just bad news. It was the signal that the system itself was failing. Credit markets froze. Businesses couldn't borrow. People lost jobs. Trillions in wealth vanished. The global economy fell like a line of dominoes. One bank, one company, one country at a time. Governments stepped in with huge bailouts to stop the freefall. And even then, recovery took years. Many reforms promised to never let this happen again. But some problems still remain. Banks remain huge, some even bigger than before. Risky financial products still exist under new names. Real estate bubbles keep forming around the world. The system was patched, not rebuilt. Fast forward to today, household debt is again at record levels. Global debt has crossed $300 trillion. New speculative bubbles, crypto tech, stocks, real estate rise and burst with familiar patterns. The scary part? Many of the same ingredients from 2008 are back: cheap money, overconfidence, and the belief that this time is different. Spoiler again, it rarely is. 1. Complexity doesn't make a system safe, it often hides danger. 2. Bubbles form when everyone stops asking inconvenient questions. 3. Crises don't start when things get bad, they start when nobody believes they can. The 2008 financial crisis wasn't just a collapse, it was a warning. A reminder that trust can build a system, and blind trust can destroy it. If you want more simple breakdowns of major financial events, hit like, subscribe, and turn on notifications, because understanding the past is how we protect ourselves from the next collapse.